Imagine having a personalized team of experts working for you to help you grow your wealth by investing in a range of assets. Welcome to the world of investment funds. An investment fund is a financial pool with a collection of capitals from many different investors. This allows investors to invest in a variety of assets, which they might not have enough capital to do so if they're not in the pooling. It also reduces risks when compared to investing in individual assets. A fund is managed by a professional fund manager who is in charge of making decisions using various strategies. So investors typically do not have direct control over investments made with their capital, and fees are charged for management, which could impact the overall return for investors. Now, let's take a look at different types of investment funds and how they help to achieve your financial goals. Mutual funds are managed by professionals who select a mix of stocks, bonds, and other assets. They provide a high liquidity, as investors are able to buy and sell shares based on the fund's net asset value at the end of the trading day. Mutual funds are available to the general public, as the entry requirements are relatively low. However, if you're rich enough to be considered a high net worth individual, hedge funds could be another option, which provides a higher rate of return, but of course, at a higher risk. More complex strategies such as leverage and short selling are used to maximize the return in a short period of time. Increased returns will of course lead to a higher management fee, since more efforts are needed by managers to plan for investment strategies. Another type of fund is non-redeemable fund. A fixed number of shares that can be traded are issued. The shares cannot be redeemed directly from the fund, and investors must sell their shares on the market if they want to exit. Despite the low liquidity, it could be a good investment choice in the long term, as a high interest rate is provided and there's a relatively low risk. Exchange-traded funds have the highest liquidity when compared to the previous three funds. They act just like individual stocks. ETFs can be sold at any time during trading hours, providing a higher flexibility for investors. They typically follow a specific index, such as S&P 500, which makes it a more stable investment. Therefore, ETFs generally have a lower management fees, as they are passively managed without much strategies applied. As mentioned just now, they are passive funds. So what are the differences between active funds and passive funds? An active fund is where a manager actively chooses investments, aiming to outperform the market to maximize potential return. Meanwhile, passive fund is where a specific market index is tracked to replicate the performance of the index to provide a rather low risk and stable return. We hope this video has given you an understanding of different types of investment funds out there in the financial market. It is important to consider your financial goals, available capital, and time when choosing an investment fund. Aiming for high return in the short run may be tempting, but your ability to take the risk should be taken into consideration when making a safe investment.